Okay, so anything else on dollar value LIFO? All right, now we go to another topic. Two more topics in chapter 10, then we're going to move to 11, maybe Tuesday, maybe a little bit later today, depending. We're going to talk about the lower of cost or market. When we looked at ConocoPhillips and Coca-Cola's annual report, they said we value inventory at LIFO, lower of cost of market, or FIFO, lower of cost of market. Now the whole idea here is that anytime an asset's value, in other words, its future revenue generating potential, falls below its carrying value, the asset has to be written down. The asset is impaired. So just like a receivable that you're not going to collect is impaired, inventory that you're not going to sell for a particular value is impaired. And as I said before, we looked at the balance sheet, a reader has the right to assume that the values on the balance sheet represent the minimum cash that you could realize from using or selling that asset. Now, as we also mentioned, we're going to apply low of cost to a market. It could be applied to all your inventory, everything you have in inventory. It could be assigned to product lines or individual items. As you start moving down the line, the aggregation of inventory lowers the loss, right? Because if you add everything you have, some items will be above cost, some will be below cost, and when you average them out, the loss is less, or the potential low of cost of market is less. Product lines, the loss is larger, and the largest loss you get is when you have individual items. Now, this goes back to this idea of low of cost of market goes back to something that we studied the conceptual framework, and we looked at the cost concept. We know that cost is a ceiling on asset valuation, and of course the lowest value could be 0. So what we're saying here is if you determine that market falls below cost, you have to value inventory at the lower of the two. So in this case, this would be LCM. And this would mean that you'd have to recognize a loss on a write down to market. You also know that based on the cost concept, that if market goes above cost, we don't recognize that based on conservatism. And in this case, cost would be lower cost of market. We're talking about inventory? Inventory. But the receivable is the same concept in terms of realization. So if the value of a receivable on the balance sheet does not reflect the cash generating ability, if it's above that amount, you have to write the receivable down. Same thing here. If the value of the asset in the marketplace is less than the carrying value on the balance sheet, you have to write it down. So you can't show a value that exceeds the cash you expect to collect from the sale. Now, as I said, you could apply this like ConocoPhillips did it for their entire inventory, product lines, or individual items. Individual items is required by GAAP, also preferred by IFRS, by tax rather, I should say. Individual items is required by tax, and you have to have an actual loss. They're not going to make the estimated. So individual items give you the largest loss. And again, that is something that you have to use for tax purposes. Aggregation is permitted under US GAAP, but you have to have a rationale for it. So I think for ConocoPhillips, their oil and gas products are very similar, so they're homogeneous, so it seems to make sense to add them up. But the other justification is here. So what we really want to do is focus in on this economic justification of why we group items. And for example, if you took the Hewlett-Packard illustration, where if they're selling their laptop computers and they give you a printer for free, the printer is worth 0, right? They have no revenue generating ability from the printer if you look at it by itself. So would you write that down to 0? And the answer is no, because you're selling the printer with the cartridges. So you give the printer away, but now you're strapped to buy a Hewlett-Packard cartridge, which is $150 or $90. And that's where they generate their revenue. So rather than just looking at the printer, we combine the printer and the cartridges as a single value that we use to assess low of cost or market. And the same thing is true with one of my clients. I think I was mentioning they manufactured construction tools, and they would give the tools away, but you had to buy the drill bits and the gunpowder charges that they use to shoot nails in concrete or whatever else you're using. But those actual hardware devices were given free. So someone would drive up to a construction site and hand out these tools, and you'd get them for nothing. But if you had to use them, the parts were marked up significantly. So actual practice, yeah, it happens, and I've seen it done, and you just combine it. But you really need a good reason to aggregate inventory. Although ConocoPhillips didn't give us a reason for it, there has to be economic justification. Now, what I thought I'd do is I'd summarize this rather than just working with the notes. Let me just tell you, let me go on the document for a second. So let's look at the lower of cost of market rules. And this is, right now, this is US GAAP. So let me explain the rules. It's all explained in the notes, but I thought I'd summarize it. This is probably the most efficient way to do it, rather than to write everything on the notes, on the board. It's going to, the way we apply under US GAAP, the way we apply lower of cost of market is going to depend on the inventory method that you use. So let me just make this clear. The application of lower of cost of market is going to depend on the inventory valuation method that is used by a company. If the company uses any methods other than LIFO or retail, we'll see the retail methods in the second half of today. So if the company uses any method other than LIFO or retail, so for example, FIFO in average cost, what's market? Market is net realizable value. The net realizable value is the selling price minus the cost of disposal. So it's the first thing you have to know. What's market? Market is net realizable value, which is the selling price minus the cost of disposal. Now that is for a FIFO or average cost company. So the problem, of course, is when you're doing some homework, or you're a client, or you're on an exam, or it's a CPA, you have to know what method the company's using. And this is a complexity that's caused by US GAAP, because IFRS is always constant. IFRS is the same as US GAAP in this case. I can tell you that IFRS permits recoveries, but only up to the original carrying value. So US GAAP does not permit recoveries, so that's something we know, and we'll talk about some exceptions. But if you're dealing with IFRS, the way it would work is if the market for that product collapses, you write it down. What happens if the market recovers? It's kind of unlikely that that's going to happen. But what if the market recovers for the product? It could if it's a commodity. So if the market recovers, and let's say the market goes up to that level, under IFRS, you can recognize the recovery, but only up to what? The previous recognized loss or the original carrying value. And where did you see that before? Discontinued operations. When you're holding the asset and you write it down. So what I always try to do is let you know, hey, you saw this before. It's a common rule, and it's applied in different applications. So IFRS, same rules as US GAAP. They have market as net realizable value, selling price minus the cost of disposal. What does disposal cost, by the way? When you sell something, what are your disposal costs? Assume you have your own business. Transportation, shipping, yeah, any kind of like fees or, commissions. So those would be your cost of selling. Those would be your cost of selling. US GAAP does not permit recoveries, but we'll talk about some of the exceptions. All right, so that's rule number one. If the company's using a method other than LIFO or retail, so basically FIFO and average, LCM is based on market, which is NRV, selling price minus disposal costs. IFRS, exactly the same, but they permit recoveries. Yeah. We'll talk about retail inventory methods, a special method of inventory. We'll see that in the next module. Okay. Now, what if you are using LIFO in retail? Then, market is something known as, market is something known as current replacement cost, or CRC, current replacement cost. I'm sorry? Yeah, US GAAP. Yeah. IFRS is done. They don't play with the ceiling floor. Yeah. Yeah, IFRS much more simplistic. First of all, why? Oh, here's a real good question. Why would forgetting about the retail for a second? Why wouldn't this apply to IFRS? That's right. That's right. So they don't use LIFO. So that's the logic as well. So, yeah. Good question. Real good question. All right. So what happens when we use current replacement cost, we build a ceiling and floor. Now let me draw this out for you. I'm going to put it on the board as well. The ceiling is net realizable value. The floor is something called net realizable value minus normal profit. Net realizable value minus normal profit. So I'm drawing this out now. So we have the ceiling, which is NRV, which is the same as the NRV above, and the floor value is NRV minus NV. Now, what I'll do is I'll give you a couple of exercises. What's the current replacement cost? That's the cost that you would have to pay to buy the inventory again and put it back into stock. So that's the cost that you would pay to put the inventory back in stock. Or the cost of manufacturing. How do you know that, by the way? How do you know that? How do you know what your next price is? The next cost or the next production run going to cost you? When do these audits take place? When do we audit the company? The next year. So we're in the company's audit cycle in January and February, so we know what they've paid to replace that inventory. And we know what they've paid to produce it again. So the bottom line is you know the current replacement cost. And the important point is we do not use this rule for FIFO and average because they are close to what? Current replacement cost. FIFO was already close to current replacement cost. So let me give you an example. Let's say the net realizable value is 20. And let's say that the net realizable value minus the normal profit is 12. Let me give you 3 current replacement cost numbers. What if current replacement cost is 18? As long as it falls between the ceiling and the floor. You don't want it to exceed the ceiling. So if current replacement cost falls between the two, then in case number 1, when current replacement cost is 18, this becomes market. Case number 2. What if current replacement cost is $23? Current replacement cost exceeds the ceiling. 20's market. So you can't exceed the ceiling. And the purpose is to prevent overvaluing inventory. Because, think about this for a second, what's NRV? NRV is selling price minus disposal cost. If the cost to replace is above that, you can't value inventory above what you could sell it for minus disposal cost. And in case 3, let's say current replacement cost is 10. What's market? The floor. So it's really, you'll always see it as what? The middle value. So if you line these up, market is always the middle value. Now, the purpose of having the floor is to avoid undervaluation of inventory, purposely undervaluing inventory. Okay, so here's the summary. What you said, current replacement cost not used for average and FIFO because it's really closer to replacement. Ceiling prevents overvaluing inventory, the floor prevents undervaluing inventory. So now we're going to move on to some illustrations. I thought it was good to summarize this, get it right up front, so you have everything tied down before we go into the illustrations. All right. Right, so this is the way the ceiling and floor works. It's a little probably too complicated. You don't see this under IFRS. IFRS is much more reasonable in that they're only using the NRV as we use in FIFO. Let's do an example. So here's the information that you have. And we're going to use it for both FIFO and non-FIFO companies. So what I'm giving you here are 4 products, 2 product groups. You've got the information. This is the cost. Where do we get this cost? Well, this cost is what? Based on LIFO, FIFO, weighted average. That's the end of the period inventory valuation. So the way this works is the same way that inventory works the same way as receivables. You're at the client location in January and February. They've already closed their books. You look at their receivables, as we did, until Tuesday, valuing their allowance for bad debts. The next step is somebody else is working on the inventory, and we get the cost. This is the cost we developed and audited from LIFO, FIFO, weighted average. Current replacement cost, as I said, this is the cost to replace those units, either looking at purchases that were made in January and mid-February, or what we produce. Selling price, well, we know what this is going to be because we have the client's information. Cost of disposal could be estimated. It could be based on sales commissions, or it could be shipping or packaging or postage. If you give free shipping, that could be your cost. And then I'm calculating the net realizable value. It's the selling price minus disposal cost, so it's 20 minus 4, the 16. And then I take away the normal profit, and it's 14. So you got the numbers. Now, first question is, what am I getting on the exam? Well, probably, everything except these last 2 columns. Right? You have to calculate the ceiling and the floor. Now, do you need the ceiling and the floor? Well, that depends on the problem. So part A tells you, let's go to a FIFO company. If it's a FIFO company, what do you need? You only need the net realizable value, correct? Because you don't need, there's no ceiling and floor, because for a FIFO or average cost company, you're only working with the net realizable value. So, in the computations, let's do them one at a time. Product A, or Group A, Product 101, cost is 18, market is 16. It's the net realizable value. What's lower? Market. So if I wanted to do this on an individual product basis, the loss is $2. I'd have to write that down to markup if I was doing this on an individual items basis. The next product, 102 in Group A. It's got a cost of 16, but its market is only 12. Once again, what's the lower of the two? LCM is going to be the net realizable value, so market is 12. And I'm going to write that down by 4. Going to Group B, Product 110, cost is 50, market is NRV, 60, less, so cost is the lower. We don't have any write-down. And then finally, when you look at our last product, 112 in Group B, cost is 80, and market is 75. 75 is lower, so market is NRV, and we have to write that down by 5. So if I took the write-down all the way through on individual items, I would have a loss of $11, or let's say I have 1,000 units, I'd lose $11,000. That's on individual items. What if I did this for product groups? Well, if you go down to the bottom group, look at the groups, and I'm going to show you the loss is 6 because you're aggregating. What does that mean? Let's go back up here. If I look at the first group, that's Group A. In Group A, what's lower? Total market or total cost? Well, total market's lower, so I'm going to take a write-down here of $6, right, on this group. Now remember, this is the printer with the cartridges, putting those together. Now for Group B, cost is lower, so there's no write-down. So when I do this by groups, I'm going to write down Group A by 6 and Group B by nothing. So my total loss there is 6. Notice that as you aggregate, the loss is going to get smaller. And then finally, I can just show you right up on the screen now. I'm going to turn the page, but when I look at total inventory, when I look at total cost against total market, for aggregate, again, this was ConocoPhillips, they're using aggregate, all their inventory, 163 versus the cost, the market's 163, the cost is 164. What's lower? Market by 1. So you notice by aggregating, it minimizes the loss. So is ConocoPhillips doing this because their products are homogeneous and it makes sense to do it? Or do they know, like everybody else, that by aggregating, you minimize the write-down? So that's what you have to think about. Again, thinking about that income smoothing, earnings management issue. So once again, individual items, I'm going to lose 11. Product groups, I'll lose 6. And for the total inventory, I have a loss of 1. And here's the total inventory, the way it goes on the next page. Now, IFRS, as always, I'm sure we got fewer credits. If we all learned IFRS, game's over, we now move on to another topic. But of course, US GAAP has one additional complication. And that is, what if the company is other than FIFO or average? What if it's a LIFO company, or if they use the retail method? Well, now we have another problem. And that problem is you have to use the ceiling and the floor boundaries. Right? So part B of the question says, well, now assume that this is a LIFO company. If it's a LIFO company, then, or scenario B, now you've got to use ceiling and floor valuation. So let's take a look at, and I'm just going to erase the numbers in here. And we know from the table on the prior page, let me go back and show you where you got this number. Now you've got ceiling and floor information. So the upper boundary for the first product is 16, and the lower boundary is 14. Where's the current replacement cost on that? Current replacement cost is also 14, so that's going to fall right at the lower boundary, so you're okay. So you could say that cost, I should say current replacement cost or the floor would be 1, either one. Let's go to the next one. And we'll do this more systematically again in a second. The next product, and then this is product Group A, and that's 101. Group A 102 tells us that the ceiling is 12 and the floor is 9. So current replacement cost is above the ceiling. And I will circle in red what market would be. So what's market in this case? 12. Ceiling is going to be net realizable value, 60. And the floor is 52. Current replacement cost is going to be 50. Current replacement cost is 50, falls below the floor, so what's going to be market? The floor of 52. And finally, in the last case, we've got ceiling 75, floor 65, and current replacement cost is going to be 70. So that the current replacement cost falls between the ceiling and floor, and therefore that becomes 1. So the market price or the market value that we're going to use in the LCM model for product A, Group A 101 is 14. Group A 102 is 12. Group B 110 is 52. And Group B 112 is 7. Those are the ones. So that when you go to the actual solution, we'll see that market again is 14, the 12, the 50, actually, is that right? Yeah, 52, and then the 7. So here's the market value. Now, comparing it to cost. So let's go to the 2 columns when we have to compare it. So here's market and cost. And I'm going to stop right now and just be sure that we all are pretty much getting the idea that the first thing you have to do is get market through this process. So with the FIFO company, you just took what? The current replacement, you took the NRV, I should say. That's it, that's market. Here, you gotta go through this extra step and look at this kind of like this machine and put in the variables and see what comes out. So now we've got the market. Well, once we get market, it operates the same way. So if you look at the market value here, if the current replacement cost is market at 14, and we put it in the floor, and cost is 18, we have to write that down by 4. In the second case, net realizable value, or the ceiling, became market, but the cost is 16. And market becomes the carrying value at this point, the lower, got to write it down by 4. When we move to Group B, you'll see that the floor value of 52 becomes market, and cost is 50, cost is lower, so there's no write down there. And the last one, market current replacement cost is 70, cost is 80, market turns out to be 70, and we need to write it down by 10. So the total loss that we would take on individual items would be $18 in this case. We have to write it down by 18. Now, it's probably going to be worse for individual, it's typically worse for individual items. Not always the case, but definitely in this case it is. Then if we wanted to do this by, so the loss on individual items is 18. If you wanted to do this for product lines, take a look at product line A. Market is 26, cost is 34, so the loss there is 8. And when we look at product group B, total market is 122, total cost is 130. The market lower by 8, so the loss is also 8. So in this case, the loss is also large, but it's lower than individual items, so the loss will be 16. And finally, when you do total inventory, it's really just comparing these two items. Let me highlight them here. And that would be 16. It's the same as the group. What's that? Yeah. Where is it? Wrong? This one. 18, yeah. No, it's right down here.
I'm sorry.
No, yeah, because you're writing this down from 18 to 14,
No.
16 to 12.
I thought that was an act.
Okay, got it. So that's 18, and the loss here is 16, and the loss on the individual here would also be 16. I mean, on the total would also be 16. All right, so those are the rules. So you just have to make sure that you practice, make sure you get the boundaries straight, and make sure you know when to use them. Now, of course, the question is now on the write-off, and we'll talk about that in a second. Yeah, so, okay, I'm not going to you.
You said that when the cost is 14, then you could choose either.
Yeah, it's the same. If you told me that the first product that you use the current replacement cost as market or the floor, it's fine. Because they're the same. They're the same. So if current replacement cost is equal to the floor value, it's fine.
So, you said that in the LIFO retail,
Yeah.
in the individual case, usually issue the awards from regular loss.
Yeah, for, in this case, the FIFO company loss would be lower because they're not using the ceiling and floor. It really depends, but the loss is much higher with the LIFO approach.
So in the 540 is not the same case.
Now, FIFO, you would have, depending on your inventory method, you have a different low cost of market rate. And it seems odd because you would think that LIFO would have, and again, just the numbers, the way they play out, LIFO generally is already understated, right? With respect to inventory, rising prices, so you would expect, you wouldn't need as large of a write-off, but it just depends on how the numbers work. Now, to write this off, so what do you do when you write them off? So let's go to the next part of this, and that is, how do you write this down? You can use one of two approaches. You can either use an approach which we call direct, which is a cost of goods sold model, or indirect, which is a loss model. So you can either put the write-off with cost of goods sold, or you could write it off indirectly through the loss. You could also use an allowance account, but let's talk about this a little bit. Why do you use an allowance account for accounts receivable? Why do we use the allowance for accounts receivable?
It's almost like fill in a space for a specific, like, I would say someone was to need to be warned, so you would put that allowance right there basically to like hold that money that they would owe you.
Well, what if you knew the customer exactly that one? If you knew the customer that was exactly not going to pay you, would you be able to?
So is that what it would?
Well, the reason is, if you don't know and you're applying an estimate against all your receivables, how would you know which customers to write off? Same thing here. If you use aggregate inventory or product lines, do you know what units should be written down? Well, yeah, you might, but you use an allowance. So the allowance makes more sense against an aggregate or a product line law of cost of market. Individual items, you probably write them down individually.
So isn't like essentially like a collision type of thing in accounting standards, like to basically like hold you from significant loss if anything does happen.
Well, yeah, I mean, you can, well, the idea also by making choices here is that it is these are like reserves or provisions for losses. Because these losses didn't happen yet, because you didn't sell them, right? You didn't sell the property. So that's why for tax purposes, what you have to do, you can't take a loss on receivables unless what happens? You know that you're not collecting it. For tax purposes, you can't take a loss here unless what happens? The inventory is actually sold at a loss. So we could use an allowance for all of them, but the allowance is probably going to be more useful with respect to product lines and aggregate inventory. So let's take an example. Let's go back to the FIFO company, as I said, and let's assume they had 1,000 units of each product, and the loss was, let's say $11 per, let's say the total loss turned out to be $11. Let's say the loss was 1,000, let's just make it 1,000. All right, so the entry that you would make, if this was going to the cost of goods sold, would be to debit the cost of goods sold and credit the allowance. Now, on the balance sheet, inventory is reduced by the allowance account. So I'm just giving you these numbers. So let's assume that the inventory was 164 and the allowance is 11. Goes down to 153. When you calculate cost of goods sold, I'm giving you all the numbers. Notice the inventory value in the cost of goods sold is consistent with the inventory on the balance sheet. Beginning inventory plus purchases, goods available less ending, which is the cost of goods sold. So let's keep that number in mind. It's 589, so that's the cost of goods sold in this case. And that becomes a charge against income. That's your expense for the period. So using the direct method, you write the inventory off directly to cost of goods sold. Now, for me, that's just like the case of when we looked at the case of the exactly for LIFO liquidation profit or loss. The liquidation profit or loss in cost of goods sold is a problem because it what? It buries the loss in there. So you would have to disclose this loss on the write-down. So this actually includes the 11,000. So the 11,000 is buried in here, very much like the LIFO liquidation profit. That's the term we use. So the LIFO liquidation profit is buried in cost of goods sold. The write-down for obsolete inventory is also buried in the cost of goods sold if you use this approach. Now you could avoid that, and this is the method that I actually prefer, is the loss method. So what you would do, the indirect approach, would debit the inventory write-down loss directly and credit the allowance. By the way, on individual items, you can credit the individual items. But notice that I think this is preferred because what it does is it actually allows you to see the loss on the face of the income statement. So again, just think about looking at an income statement, and a company writes down inventory, it's significant. If it's buried in the cost of goods sold, you don't see it. And just like all of us, we don't read footnotes, right? Whether it's in a textbook or it's in a financial statement, you probably don't spend as much time on them as you should. The first thing you look at is the income statement, and you see the cost of goods sold. You don't see, just like we didn't see liquidation profit, we don't see the write-down. So by doing this, for me, it's more transparent and it's a better disclosure. The problem, of course, is not a big one, but when you look at the balance sheet, of course, that stays the same. You write that down. But on the cost of goods sold, you would use the inventory before the loss. So now, the cost of goods sold on the indirect, this is direct, it's 578. The difference is as a loss. Same amount. Right, it comes to the same amount, but it's going to be shown differently. So under the direct method or the cost of goods sold method, the loss is in cost of goods sold. You don't see it. Under the indirect method, as they call it, you show the loss, and the cost of goods sold is going to be reduced by that loss. Now I'm just showing you this for the computations. But again, in the indirect method or the loss method, the cost of goods sold is calculated without considering the write-down. So that inventory that you see here is not the same as the inventory on the balance sheet. All right, so if you look at this inventory, it's 164, but on the balance sheet, it's 153. So the cost of goods sold under the indirect method is calculated by using the inventory value without the write-down. Without the write. That's because the write-down comes through on the loss of the income statement. So those are the two approaches. Now, one last reminder. You could, if you wanted to, as I said, you didn't have to use the allowance here because there are individual items. So you know exactly what items we wrote down. We know we wrote down Group A, Product 101. We know we wrote down Group B, Product 110, for example. So we could have written those accounts down directly, but an allowance account could be used. There's one problem with the allowance before we move on to the next module, and that is, although US GAAP does not allow recoveries, by using an allowance, you may actually be forced to recover. So for example, let's take a look at a case where you've got inventory of 118. Let's say the beginning allowance was 11,000. Let's say it's the same one we had before. Let's assume that the inventory is going to be written down to 110. So we believe that the LCM value is 110. So if you need to have an LCM value of inventory minus the allowance, what is the target balance in that allowance account? You need to have 80, right? So that means the adjustment has to be 3. I have to reduce the allowance by 3,000. And the only way I could do that is if you look at the journal entry, is I have to debit the allowance, and then I've got a recovery gain, which happens. It happens on receivables also, but it's not preferred by GAAP. US GAAP really doesn't want this to happen, but as a byproduct of using either the allowance for bad debts or an allowance for LCM, it's going to happen. It's going to happen. There's no other option. You have no other option here but to take that into income. Some might argue you could take it into other comprehensive income. Some might argue you could take it directly to retained earnings. But most often it's going to run through net income. Okay. All right, so that's all I have to say on LCM. We move on to retail methods in a second, but the rest of the inventory. Any questions on this before we move ahead? Yeah.
Do we ever close these accounts?
I'm sorry?
Do we ever close these accounts?
The gain, yes, but not the allowance. The allowance is a permanent account. The allowance is permanent. So it's a balance sheet account, it stays there. Now, the only time you close it is if you either did not need it, so if LCM goes to cost. So let's say that the LCM in this case was 118, then you would debit this to 118 and it would go to 0. But it's not part of the closing process that we covered in chapter 4. All right, anything else? All right, so now, by the way, the last thing here, we've already covered the LCM, so for IFRS, and again, you need to know that as we keep going. Okay. And this is going to make use of estimating any inventory. And you have to estimate any inventory for lots of reasons. Sometimes for, as I'm showing you here, quarterly statements or monthly statements. You don't want to count inventory. There's also cases where inventory is damaged. Insurance claims, forensic, you hear a lot about, forensic auditing or forensic accounting. You have to come up with techniques to, come up with an inventory estimate. And also a first pass valuation, let's say an immersion. We used to use, when I was going to college, worked at a retail with Sears, we used to use estimating inventory every week. We would come up with an estimate. And we would check stock, and that would determine if there's any theft or any damage or any spoilage of products. That could be determined by looking at the estimate versus what we had in stock. So it is done sometimes as part of internal controls for companies. Now, two methods that we're going to be looking at. Number one, gross profit. And this can only be used for internal or quarterly statements, cannot be used for annual reporting. And then we're going to look at retail methods. And we're going to look at 4 different retail methods. And these retail methods actually will simulate average cost. They will simulate lowest cost of market. I wanted to show you FIFO to be complete. It's not in the textbook, but it really helps you see the entire picture. And then the LIFO retail methods, there are 2 of them. One of them is LIFO, straight up, and then there's dollar value LIFO retail. So we'll see all of those as we move along. Now, one of the things that you should know about retail, if anybody works retail right now, is that companies keep their books under 2 systems. They've got cost and retail. So I remember when we took inventory, we valued inventory at selling prices, right? The cost, maybe somebody knew the cost somewhere in the organization, but we would actually count the inventory and value it at retail prices. So we've got dual reporting or dual recording inside the company. We've got cost and retail values. When you look at markups and markdowns, we need to define them. And for whatever reason, this is a big issue with respect to the CPA exam. You have to know whether the markup or markdown is expressed as a percentage of cost or a percentage of selling price. So let's take an example. And I'm first going to set this up in a way that I think you kind of already know. So you've got a company that sells a product for $75, and it costs the company $60 either to purchase or make this product. And it's got a gross profit or a markup of 15. So you have sales, you got cost of goods sold, and you got gross profit. Now, the gross profit as a percentage of sales, is going to be 20%. And the cost percentage is going to be 80. That's your profit margin, your gross profit margin. Now, when you're running a business, and this is important. So when you look at that cost percentage of 80, that is a percentage of selling price. But that's not necessarily the way you would run or manage your business. You would buy the product for $60, or you would manufacture it for $60, and then you would say, I want to make a certain percentage on that cost, right? That's the way you would think if you were running your own business. That would be known as a markup on cost. A markup on cost is not the same as the cost of goods sold percentage. So this number is the COGS percentage, and this is not a markup on cost. This is the gross profit margin, but this is the markup on selling price. It is the markup on selling price. So the markup on selling price is the 15 divided by the 75 that you see here. The markup on cost is 25%. So you're running your own business, you buy a product that costs you 60, your goal and what you need is a 25% markup on that cost. Therefore, you would have a $15 markup, you'd sell that product for $75. And that's the way you operate in business. Now, the problem, for whatever reason, in a lot of the CPA exam questions, they will only give you the markup on cost, not the markup on selling price. Or they'll give you the markup on selling price and not the markup on cost. So you have to know how to convert them. So I'm just giving you this. This is not a major issue, but it's something you need to know. So if I've got the markup on cost, and I want to get the markup on selling price, that's the calculation. It's the markup on cost divided by 1 plus the markup on cost. If you want to try that, the markup on cost in this example is 25. 1 plus that amount is 1.25, and the markup on selling price, which is the gross profit percentage, is 20%. So in most cases, what I've seen is that you were asked to do something with a gross profit margin. So now you're taking the CPA exam, or taking one of my exams, or doing homework or something, and you're asked to do something with the gross profit margin, but I tell you, you got a markup on cost of 25%, you got to convert it. That's why I'm showing this. It happens a lot. You'd have to convert it. Now, of course, you could be given the markup on selling price, and you could be asked for the markup on cost. So that if you're given a markup on selling price at 20%, it's 20, I should say. That's 80.2 divided by 0.8 is going to be 25% on the markup on cost. So that's the way you convert it. It's just a simple formula, but you got to remember that, especially when you need the gross profit percentage. You're going to need the gross profit percentage in the next method we're going to show you, which is known as the gross profit. Okay. All right. So questions on the first. Differentiating between markup on selling price, markup on cost, and differentiating between the markup on cost and the cost of goods sold percentage. This difference is the one that most people confuse. So giving you this base information, a lot of people would take that 0.8 and assume that that's the markup on cost. That is not. That's the cost of goods sold percentage. Actually, that's cost divided by selling price, which is the cost of goods sold percentage. So now, you need this, and I got a couple of other illustrations here, but let's do the gross profit method. So as I said, the gross profit method needs the markup. The gross profit method needs the markup on selling price. So once again, we would use this for, monthly or internal inventory controls. You might look at this for interim periods. You might want to see if you can pick up a damage or stolen merchandise, and you might use it in budgeting and forecasting. The gross profit method cannot be used for annual financials And it's based on a very simple model. It's based on the cost of goods sold or inventory calculation. So let's say that you're doing some forensic accounting. And in that forensic accounting, you're asked to go to a site where inventory was damaged or no longer capable of being counted. You know the beginning inventory and purchases. Where do you get that from? Company's records, right? So the company's records will tell you the number and number of units and the selling and the cost rather of the beginning inventory and the purchases. So you know the goods available for sale. Now, historically, you would know the company's gross profit method or its gross profit percentage. And therefore, you go back, take an average, and you would say, well, over the last 5 years, I have a gross profit percentage of 20%. My cost percentage is 80%. So when you look at this cost percentage, depending on the textbook, and I'm just going to tell you this is 1 minus the gross profit percentage, or 1 minus the markup on the selling price. And once you take that cost percentage against the sales, how do you know the sales? From the company's records. You can estimate the cost of goods sold. Now again, this is a 5-year average or something. You know, this could be a 5-year average cost ratio. Put some numbers in here in a second. Now, one of the things that's said as a disadvantage of the gross profit method is that you are using a 5-year average, so these are historical numbers, which may not reflect this year, but again, it's a good starting point as an estimate. All right, so let's do this. Let's take a look at some numbers, and then we'll break here and we'll talk a little bit about next week. All right, so let's assume that you have a Boyer company that experienced a major casualty in 2020. All of its inventory was destroyed. Began the year with inventory of 800. There were net purchases. Those were purchases minus purchase returns and allowances. Net sales, so 4 million of net purchases. Net sales of 5 million. Net sales minus sales returns and allowances and sales discounts during the year. Historically, over the last 5 years, let's say the company's gross profit percentage or margin is 30%. That's the markup on selling price. We are asked to estimate ending inventory using the gross profit method. Got the beginning inventory of 800. That you know from the company's records. You've got net purchases of 4 million, which you know from the company's records. So goods available for sale, 4.8 million is known. We take net sales, 5 million. If I subtract out the estimated gross profit of 30% on sales, I get 1.5. Estimated cost of goods sold is 3.5. And then ending inventory is estimated at 1.3. So that if you, let's say this was a fraud investigation, you go out and count the inventory and compare it to the 1.3. Or for an insurance claim, right, how are you going to apply for insurance claims? You've got to think about, again, this is all part of forensics, you've got to come up with an estimate. Now, the other way I could have done this, and you will be correct no matter which way you do it, is to say, look, I know that the markup on selling price is 30%, or I know that this is the COGS, the gross profit margin. If I take 1 minus the markup on selling price, or 1 minus the gross profit margin, I've got the cost of goods sold percentage. And that COGS percentage of 70% on the net sales of 5 million estimates the cost of goods sold at 3.5. and you would get the ending inventory at 1.3. Now this, as we said, is useful internally. It's useful for internal control. You could use it for quarterly financials, cannot be used for annual reviews. All right,